In this video, I want to examine the concept that difficult markets are usually followed by easy markets and easy markets by difficult markets. So this is the Dow. You can see this is a perfect example. As we came out of the election here, um, the Republicans took the presidency in both houses of the Congress, so things were going to get done. The market took off, very strong momentum move and a breakout from this sideways chop. So the definition of an easy market. And at some point, the market gets too overbought. Sentiment is too bullish. Nobody left to buy, and then we either roll over into a bear market, which I don't think we are ready to. Obviously, we are not ready to start a bear market yet. I think we've got another 10 years of this bull market still, but we need a period of consolidation. So the market transitions into this difficult, sideways, choppy market. And that's what we've been in for most of the last 2 years. I think we're breaking out of that now. We're about ready to transition into another easy period in the market. Although I do think we're probably have to come back down and retest this zone here one more time. So we've broken out, but I think we're probably going to have to drop back down and retest maybe, I don't know, 2,700 or something like that, and another intermediate degree correction, and then we can start the advancing phase of this, the next advancing phase of this bull market in earnest. So this is an illustration of easy markets being followed by difficult markets, and I think we're about ready to transfer into an easy period again in the stock market. Now I want to take a look at the metals market, because this is playing out here as well. This is more of an intermediate term chart, so you can see this was a very difficult market, and I'll widen this out in a minute here, and you can see that the last 6 years have actually been very difficult. Very difficult market as we formed this cup, and then the handle here. So as I explained in real time, this was a very difficult market to trade. A lot of volatile swings back and forth. Very hard to hold on to this. And right about the time the market started to get easy in here, that's where the top came. And then we get the corrective move into the handle part of the formation. And again, right as people were becoming used to and accepting that the metals were starting to go higher, then we pull back for several months into this corrective phase. So difficult trading here. And then this gives way to a very strong, trending, very easy to make money move, an impulsive move out of the handle. And again, right as it becomes, everybody jumps on the bandwagon, the people are making money quick and easy. Then we transition again into this difficult corrective phase. And I would say the more people become conditioned to expect this, the longer this tends to last. Now, these kind of sideways corrections usually are the launching pad for strong trending moves, just like this was the launching pad for this. But because people have become conditioned to this kind of behavior, they are not prepared for this sideways choppiness, and this tends to be a very frustrating period because people want this to end quickly and they want another one of these to begin, and very often this sideways chop takes longer than they want. So let me zoom in a little bit. All right, so you can see this really hasn't done much damage price-wise. This is damaging mental capital is what it's doing. So it's more or less just churning sideways to slightly down, not really doing a whole lot of damage to price, but it's making it very difficult. And I've seen this with some subscribers. What they've done is they are anticipating another one of these. They expect it to happen quickly, so they've taken very heavily leveraged positions, but they have not bought enough time. They were expecting this to be done quickly in 3 to 4 or 5 weeks, and we're now 3.5 months into this sideways churn. And so they're what they've done is they've bought option positions and they haven't bought enough time. And so this is what happens during these sideways churns. The market will get short-term overbought, and traders that have become conditioned to this expect this overbought condition to embed and price to take off, and it doesn't. It turns and goes back down and becomes oversold. And this is about the point where the bears start to short heavily, and then the market turns back up, and then the bears lose money. So it is a market that is just bouncing back and forth from short-term overbought to short-term oversold, and there is no follow-through in either direction. So it's very difficult for either side to make money, bulls or bears. Ultimately, this is just a corrective move in an ongoing bull market, and at some point, one of these overbought conditions is going to embed, and price will do this. We'll get this heavily embedded overbought condition, and that will be the signal that the next impulsive leg is underway. And so this is the problem with these sideways choppy corrections, is you just don't know ahead of time which one of these overbought conditions is going to embed in the overbought condition, and then the next trending move is going to start. So you almost have to just pick a point. Once you get some kind of signal that the bottom is in, and we have that. I've shown you charts of the mining indexes, which cannot be shorted and artificially suppressed. The mining indexes are clearly saying that an intermediate bottom has occurred. I'm not going to draw it in on this chart, but price has broken the intermediate downtrend line right here for both gold and silver and miners. And miners, even the ETFs are above the 10-week moving average. So the signs are in that this is a bottom, but there still is no sign that the next impulsive leg is ready to take off. Maybe this is it, and we turn and go back up next week, and we start to embed in the overbought position. There's no way to know, but this is a very bullish pattern, and it should eventually unleash another impulsive leg higher. It's just traders have to have the patience to wait for that move to begin, and it will at some point. In the meantime, we're just bouncing back and forth, and this market is taking money away from both bulls and bears that are anticipating a trending move in one direction. We don't have that trending move just yet. And now I'm going to widen the chart out a little bit, and you can see, remember that concept, difficult markets are followed by easy markets. Gold has been a very difficult market for 6 years, just churning in this consolidation box, building this base, and it finally broke out of the base this year with a very strong impulsive move. We're correcting that move, and we should have another strong leg up. My guess is we're probably going to go to 17 or 1800 during this next impulsive leg. So this difficult phase should be followed by a phase of easy trading. And I don't think, not for a second, that easy phase was over with just this one impulsive move. think there's much more to come. I think we have started the next bull market that will make new highs, go above 1900 in the next decade, and probably somewhere between 5,000 and 10,000 before this bull market is done.